Hello everyone and welcome. In this video we're going to explain the basics of company valuation, so that you can enhance your analysis of potential investments. Let's get started. At the Personal Finance Institute, our mission is to bring financial literacy to you, so that you can plan your financial future. If you are finding our content useful, informative, and you'd like to see more, please do like, share, and subscribe. Valuation is a highly judgmental exercise, and the best way to get a full view on the valuation of the target company is to use a range of valuation techniques, and to consider them together. A good way of representing this visually is by using a football field chart, such as the one shown here. We're going to discuss each of the methods shown, and we've also included a link where you can download a football field chart template in the description. The basic idea for company valuation is to calculate the value of the whole company, before calculating the value of an individual share. When assessing company value, it's important to understand the distinction between equity value and enterprise value. Companies have operating assets which produce cash flows, which in turn produce a return for debt and equity holders. Enterprise value refers to the value of all of the operating assets of the business, which is associated with each of the various forms of capital which fund the business, both debt and equity. This gives rise to the equation, enterprise value plus cash equals equity value plus the market value of debt. Cash is not an operating asset of the business, and is effectively negative debt, which is why it is considered separately. Rearranging this gives the equation equity value equals enterprise value minus net debt. If we're looking to value a shareholding, then we're interested in the equity value, and we can calculate this either directly, or by working backwards from the enterprise value, as we shall explain. Though there are many methods to value a company, these can be broadly grouped into two distinct approaches: relative valuation and intrinsic valuation. Relative valuation is where the price of other companies is used to draw a conclusion on the value of the target company, relative to its peers. The primary examples of this are using precedent transactions, which refers to previous sales of businesses, and using financial multiples as a way to compare to other listed companies. Typically, the multiples approach is the more practical of the two for investors, and it has the benefit of being more current, and therefore more relevant, than using historical transactions. Here we have included a list of the most common valuation multiples. In order to calculate the company value using a multiple, the first step is to first identify the best multiple, or range of multiples. When using multiples, the base metric you are using must always match up with what you're calculating. For example, earnings and net book value relate only to equity capital, as they are net of debt and interest, and therefore earnings and net book value should only be used as a multiple for equity value, and not enterprise value. Similarly, revenue and EBITDA are metrics which relate to all of the operations of the business, rather than just equity, and therefore they should only be used to calculate enterprise value. The next step is to identify peer companies within the industry, the more similar the better, and to calculate the relevant multiples for those companies. No two companies are exactly alike, and therefore the next step should be to consider adjusting the multiple, depending on differences in the risk and/or growth associated with the companies being compared. Risk factors for a company can include size, level of debt and financial stability, history of earnings, experience of management, geography, and more. Finally, by applying a range of the relevant multiple, you can estimate a range for valuation. Intrinsic valuation refers to valuing a company independently from other companies, based on the cash flows that the company will generate. This is commonly referred to as discounted cash flow analysis. The logic of this method is that, in theory, the value of the company is equal to the present value of all the future cash flows it will generate. Cash flows in the future need to be discounted to their present value in order to account for the time value of money, as well as the risk associated with the business. We'll release a full step-by-step video on completing a DCF analysis, however in this video we'll explain how it works on a high level. The first step in calculating the intrinsic value is to forecast cash flows. The typical approach to a DCF is to forecast specifically for a number of years, perhaps 5 or 10, and then after that estimate a terminal value using either a perpetuity calculation, or using a multiple. The cash flows that will need to be forecast will depend on whether you're calculating enterprise value, and then deducting net debt to calculate equity value, or if you're calculating equity value directly. Generally, it makes sense to calculate the enterprise value first if the capital structure of the entity fluctuates a lot. This is because the risk associated with the equity value is likely to change a lot and the discount rate relevant now may not be relevant for later periods. If calculating enterprise value first, we'll need to forecast free cash flow to the firm. This is the net cash generated by all of the operations of the business, before any interest on debt is deducted. Each year of cash flows must then be discounted using the WACC, or weighted average cost of capital, in each forecast yearly cash flow, by multiplying by 1/1 plus WACC, to the power of t, where the cash flow occurs as in t years' time. The point of the weighted average cost of capital is to calculate the average level of risk for all of the capital holders, and we must use this discount rate since free cash flow to the firm relates to all of the business operations, not just those which are residual for equity holders. The total of all of the discounted future cash flows is equal to the enterprise value, and from here net debt can be subtracted. If calculating equity value directly, then we need to forecast free cash flow to equity, which is the residual cash flow after all interest on debt has been paid. This is equal to cash flow generated from operations, minus capital expenditure, plus or minus any changes in debt. Once we have forecast free cash flow to equity, this will likewise need to be discounted, but this time we need to discount by the cost of equity. Cost of equity represents the time value of money, as well as risk, specifically related to equity capital. Discounted cash flows are theoretically the most accurate estimation of value, however they are highly judgmental, and highly sensitive to the assumptions applied. This is not to mention time-consuming. Again, it is a complicated process, and we'll be releasing a full step-by-step video to cover this in detail. That's all for today everyone. This video was brought to you by the Personal Finance Institute. Please do remember to like, share, and subscribe, and please do post any questions you have below and we'll be happy to answer them.